Hi, I'm Kaushik, the product manager at Multipl. I've been looking at all your queries on the WhatsApp group regarding the fee, the advisory fee that we have recently started to charge. So we've been responding to all the queries, but we also thought, why not do a video about it? So I'm here with Vikas, the co-founder and
Hi.
chief investment officer at Multipl. So I've noted on all your questions from WhatsApp. So I'm going to ask all these questions to Vikas so that we all understand the rationale behind charging the advisory fee. Yeah. So Vikas, I have top 9 questions that the users have been asking on the WhatsApp group. The first question is, we are already paying an expense ratio to the AMC. Why is Multipl charging the advisory fee of 0.04%? What's the rationale behind it?
Yeah. So the expense ratio which is being charged by the AMC is the fee for the fund management which the AMC is doing. Now, when it comes to the plans, what Multipl is advising as an investment advisor is direct plans. And also there are distribution platforms as well as individual distributors who give regular plans. Now both the plans have expense ratios, no doubt, but the expense ratio is different for each of them. The expense ratio for regular plans is typically much higher. Some cases, like some of the equity funds, it could be even 1 to 1.5% higher than the expense ratio for direct plans which we are offering. Now the reason we are giving direct plans as an investment advisor is to maintain the unbiased nature of our advice, to make sure that there is no conflict of interest, and hence we are not getting anything from the AMC as commissions, and hence the expense ratios which you are paying on your direct plans are much lesser.
Got it. Got it. Because and the second question is, a lot of users wanted to understand how much they would be paying the advisory fee for their investments for the monthly SIP. So I just taken an example of the user is paying 5,000 rupees as SIP for a goal date of 6 months. What would be the advisory fee that they would be paying approximately?
Right. So SEBI allows investment advisors to charge either fees of up to 2.5% per annum on the assets under advice, or a fixed fee of 1,25,000 per annum. Multipl is charging only 0.04% per month, which would equate to roughly around 0.5% for the full year. And on an SIP of 5,000 for 6 months, the total investment here that is happening is around 30,000, and the fees that somebody would be paying would be approximately 35 rupees over the course of those 6 months. So, and I mean, just in another way, if we look at it in a more simpler way, for every 1 lakh rupee which is being invested for 6 months in a SIP mode, the fees would be just about 100 rupees.
Got it. Got it, Vikas. So the next question is, what is 0.04%? Whether it's on the user's SIP or per month or on total investments?
Sure. So the 0.04% fees is on the investment. Now in the first month, when the first SIP is going, it will be equal to the SIP amount. But from second month onwards, the return which is being generated is also a part of the investment value which is available to the investor. So for the second month onwards, the fees would be on the investment value, and whether it goes lower than the total SIP, cumulative SIP value also.
Got it. So the next question is one common question that we've been getting for a long time, which is, how is Multipl's plans better than index funds?
Sure. Index funds are getting quite popular, especially in US. They have been quite popular for a long time. However, the Indian markets are different, especially when it comes to information asymmetry. It is still there in the Indian markets, relatively more. And there are funds which have been outperforming, for the same reason. And there are funds which are generating returns much higher than the market. They are generating alpha over the market returns. And when Multipl is advising, we are not just giving an index fund which is an average return fund, but rather we are, basis our study, basis our quantitative and qualitative research which we are doing, we are trying to allocate funds which probably will beat the market while also maintaining the risks, right? While also mitigating the risks. Because we don't look at just the return parameters when we are researching schemes. We are not looking at just like the 1 year return. We are also looking at various risk parameters to make sure that the manager is also managing the risk very well. So if a manager is able to generate higher return, rather like to offer that to our investors than an index fund which is just a market average.
Got it. So the next question you have already answered some part of it. The question is the advisory fee charged only on our investments or investments plus returns?
Right. So as I mentioned earlier, it is on investment plus returns, and this is the industry norm. I mean, whether it is a mutual fund or a PMS or AIF or any other kind of an investment, the fees is always on the investment done as well as the return generated on it. Now, as I mentioned earlier, if it goes down, the fees will be lower. If it goes up, the fees will be higher. But it is going to be on the total cumulative amount, including the returns. And that's the industry norm all across, not just in India, across the world. That's how it is done.
Got it.
And even for regular plans, where it is commission-led plans, there also the commissions are being calculated on the investment plus return. So whether it is a direct plan where there are no commissions or whether it is a regular plan, the fees or the expense ratio which is being paid is on the total cumulative investment.
Understood. So the next question is, in any case, an investor wouldn't be paying more than 1,25,000 rupees, right? Can you clarify more on this?
Yeah, so as I mentioned earlier, it is one of the ways that we can charge. Either we can charge a fixed sum of 1,25,000 or we can charge a percentage based fee, not both. Now, for a 0.04%, if we had to equate it to 1,25,000, that would require an investment of almost 2.5 crores. And if somebody wanted to invest that much of an amount, we would be more than happy to offer our personalized, customized HNI and NRI services. In fact, even with a 25 lakh rupee amount, you can avail those services.
Understood. Yeah, this is another question which we get quite a lot of times. There are apps where a user can invest in direct plans without any charges. Why does Multipl charge?
Sure. There are reasons why we charge and there are reasons why we deserve the fees. I'll first focus on the reasons why we charge. As I mentioned earlier, we don't get any commissions from the asset management companies or any form of compensation or payments in any form we don't get from them. So when they are not giving us a single penny, we need to have a source of income. Now the other platforms also is the same thing. They also don't get the commission, but they might be trying to cross-sell different products. Multipl is not trying to cross-sell any other products. Multipl is offering the mutual funds basis, the goals basis, the suitability. And while we do have brands which are again aligned with the goals, we are not making it compulsory or mandating it or pushing it to them. It's for the users to determine based on the alignment with their goal, based on the offer which they are getting, whether they want it or not. There is no compulsion. People are taking that offer because it is adding value to them. The benefits which they are getting from the brands are adding a lot of value, and that's why people are redeeming. But there is no compulsion or no sales push for that, right? So when it comes to investment, we want to earn the fees rather than try to earn it in a different way, whether in form of commissions or whether by peddling products which may or may not be needed, which may or may not be suitable.
Got it.
And coming to the and of course SEBI has made it quite clear that investment advisors need to charge a fee that is based on the regulations. They require the fees to be charged, and again the reason is to protect the interest of the investor so that they are not charged in a different way. Rather, it is very transparent and clear form of compensation. Now coming to the reasons why we deserve a fees. Firstly, we have a well qualified and experienced investment research team which is comprised of chartered accountants, IMMBAs, CFA chartered holders with long experience across the best in the industry like Goldman Sachs, Bank of Montreal, ICICI Prudential, etc. This team is doing full-time research on a day in day out basis, looking at the various investment options under the mutual fund umbrella. Also, we are looking at the suitability. So secondly, we are looking at the suitability as to, is the investment aligned with your risk profile? Is it in line with your time horizon of your goal? Is it in sync with the current market valuations as per our proprietary market valuation model? is it aligned with the amount of the goal, the number of schemes that we are giving? Like, are we giving too many schemes for a small amount? No, we won't do that because it will just lead to too much of diversification. Thirdly, we are following a SLR philosophy, which is like safety, liquidity, and returns. Now, while everyone is focused on returns, and returns is what is being used to sell the mutual fund products, but equally important, is to manage the risks, which is what the team is being, focused on. And that's why when we are looking at allocating any investment option under the direct plans which we are offering, we are first looking at the safety and liquidity so that it ensures that when the goal is due for maturity, you don't face any issues in fulfilling that goal. The amount is available to you. Lastly, we are also doing rebalancing. So it's not that we gave an allocation to you and then we just forget it. We are monitoring those allocations, the scheme allocations which are being given, and based on the market conditions, we would make you switch into different funds. So for example, while today we are offering pure debt funds for the short-term goals, earlier we had offered some hybrid exposure also for the short-term goals. And when the markets rallied and the valuations started getting richer, we made those users, investors, switch into safer liquid funds so that they can meet their goals when they are due. Also for the long-term goals, we had earlier given small cap funds which have done very well to investors for their long-term goals. But now that the valuations of small cap segment and mid cap segment are excessive, we have again made them switch into funds which are relatively less overvalued. So this kind of monitoring and rebalancing which is being done, which also ensure the investors meet their investment objectives, especially over a longer cycle.
Got it. The last question, and I have one more common question. The last one is, how is Multipl better than bank savings? Because a lot of users compare the money that they earn from Multipl with their savings amount and their interest. So can you clarify more on this?
So the bank savings, especially when it comes to the larger, safer, reliable banks, the savings account interest is typically about 3%, and the FDRD interest is just about 4 to 6%. Yes, there are smaller banks with not such a long track record, or maybe with not such a great credit history, which might offer a higher interest, but then it comes with certain risks. Compared to that, over a cycle, a Multipl user would probably make anywhere between say 6-7% in debt funds to 12 to 15% in hybrid schemes. Effectively, over a cycle, maybe 10 to 12% kind of a return, which would be around 2 to 4x of what they would get in the bank savings. There could be little volatility at times, but still the returns over a period of time would be higher. And to ensure that the volatility doesn't impact, we are monitoring the funds, we are helping them rebalance so that they don't get impacted by that volatility and still meet their goals.
Got it. The last question is regarding the exit load. The funds that we recommend to the users, we allocate to the users, would they be having exit loads by the AMCs?
So it's not just about the funds that we allocate. Most funds from most AMCs would have some exit load. The debt funds typically would have a lesser exit load because the expense ratios are also lesser, and the time window also for debt funds is typically lesser, maybe 7 days, 14 days or 28 days depending on scheme to scheme, fund house to fund house. When it comes to equity funds, typically the time window is much longer, almost a 1 year window most funds would have. If anyone withdraws before 1 year, there would be an exit load. And also the exit load would typically be higher, maybe a percentage or 1.5-2% also in some cases. The reason being that the equity fund manager is investing for the long term, and they need that long-term commitment from investors to make sure that the near-term volatility in the markets doesn't impact the fund and all the investors of the fund, and to discourage investors from withdrawing too soon and impacting the fund, they have this exit load. So it's again universal, it's nothing to do with Multipl alone. And of course, when we are selecting the funds, we are trying to see that if there are good funds with a lesser exit load and a lesser window for exit load, obviously we will prioritize those funds over others.
Got it. I think that's about it, Vikas. Thank you so much for your time.
Thank you, Kaushik. Thank you, everyone.
Thank you so much, folks. Keep posting all your queries on the group. We will definitely try to respond as soon as possible. And if you have any query that you need clarification or more understanding from Vikas or any multiple team members, feel free to let me know. Feel free to ping me on WhatsApp. I'm happy to do more sessions like this. Thank you so much.